Morning everyone, welcome to Ainsley News. It's Wednesday the 15th of September. Talking debt ceiling versus deficit versus history. Here we go again. Last night saw more losses on Wall Street as the CPI inflation print came in strong, albeit slightly lower than expectations. Transitory, as a term, took another hit. This fueled a strong gold rally and shares fell, now putting them in the red for the month so far. The prospect of higher rates and tapering amid the debate over the US's next massive $3.5 trillion deficit funding relief package and looming debt ceiling is increasingly weighing on the market's mind. So let's look a bit further at what is truly mind-blowing setup in the US. First, a reminder, the US official government debt is $28.76 trillion. Not included in that number is all their committed but unfunded liabilities, such as future Social Security, Medicare, etc., of around $156 trillion that they simply choose not to put on their balance sheet. Any public company under the GAAP rules would have to do so, but not, it seems, the US government. So how are they going to pay that debt down? Well, they haven't run a real budget surplus since 1969. But for context, let's look at the deficit spending over the last 2 years compared to the previous years over the last decade. As you can see in these next charts, we're going to show you. 11 months into the US fiscal year, they have spent $2.7 trillion more than they received, slightly better than the same period last year of $3 trillion. If we look at the 17 months from the start of the COVID crisis, they have spent $5 trillion more than they received. Tax income now accounts for just 50% of the budget deficit. And the kicker? The US is actually running twin deficits, with their trade deficit also running over $1 trillion. So what are they going to do to address this imbalance? The Democrats are right now trying to railroad through another $3.5 trillion stimulus package, the biggest of all time. Somewhat inconveniently, they also need to resolve the current debt ceiling. The word ceiling is quite misleading for two reasons. It's more so a target than a ceiling, as they always hit it. But even that's not right, because now for some time they've implemented a suspension of the ceiling rather than a new quantified ceiling. That means, they say, let's not worry about it until later on. That's much easier than facing the public and saying we are raising the debt ceiling to whatever it needs to be. And by the way, we're pushing through a $3.5 trillion deficit-funded stimulus package. Even the willfully blind would see the implications. On current projections, the US government's use of cash and extraordinary measures, a la accounting tricks, will see them run out of money in late October, unless a deal can be struck with the Republicans to suspend or raise the debt ceiling. In 2013, we saw a total government shutdown for 16 days, seeing 800,000 American public servants stood down and an estimated 0.6% hit to GDP, with $24 billion taken out of the economy. We then again saw the same in January 2018, and again over December 2018 to January 2019 to similar effect, the latter going on for 35 days. You can read or listen to Goldman Sachs' detailed view below, but in short, they're calling this the riskiest debt limit deadline in a decade, and they're concluding as follows. The upcoming debt limit deadline is beginning to look as risky as the 2011 debt limit shutdown that led to Standard & Poor's downgrade of the US sovereign rating and eventually to budget sequestration, or the 2013 deadline that overlapped with a government shutdown. Like in 2011, sizable budget deficits have motivated Republicans to use the debt limit to win policy concessions. Like in 2013, the deadline falls soon after the end of the fiscal year, raising the prospect of a government shutdown on top of debt limit uncertainty. Yet again, we have clear and growing signs of a grand credit cycle in its death throes. What a looming US default reminds us of is the two additional safe haven assets, gold and US treasuries, and indeed government bonds globally. Only gold has no counterparty risk, is no one's liability. Buying bonds is buying debt in a world saturated with the stuff already and totally relying on the issuer to pay up, and hoping they do. Interest rates are already zero or negative, and hence bonds have very limited scope for higher prices regardless. Gold and silver have extremely limited supply, have no counterparty risk, no paper promise whatsoever, and have proven to be the preeminent assets over 5,000 years of countless credit cycles going pop. In one of the most ironic quotes of the ages, JP Morgan himself reminds us, gold is money. Everything else is credit. Likewise, the head of the world's largest hedge fund, Ray Dalio, famously said, "If you don't own gold, you know neither history nor economics." History is definitely repeating, and are you paying attention? If you're interested, Goldman Sachs' view on the debt ceiling playbook is as follows. We estimate Congress will need to raise the debt limit by mid-October, though it is possible the Treasury might be able to operate under the current limit until late October. It is possible, though not likely, that the Treasury might be able to continue to make all scheduled payments until sometime in early November if the deficit is smaller than expected. There are two procedural routes congressional Democratic leaders can take to raise the debt limit, but neither of them is easy. Democrats would not need Republican support if they use the reconciliation process, but they would face a number of other procedural and political disadvantages. Attaching a debt limit suspension to upcoming spending legislation looks more likely, but this might not succeed and could lead to government shutdown. A failure to raise the debt limit would have serious negative consequences. While it seems likely that the Treasury would continue to redeem maturing Treasury securities and make coupon payments, if Congress does not raise the debt limit by the deadline, the Treasury would need to halt more than 40% of expected payments, including some payments to households. Beyond the direct impact, the debt limit could also affect medium-term outlook for fiscal policy. We already expect the Democratic fiscal package to be scaled back from the proposed $3.5 trillion per 10 years in new spending to just $2.5 trillion, offset by around $1.5 trillion in new tax revenue. While there is not necessarily a direct linkage between the debt limit and the fiscal package, the more these issues become entangled, the more pressure there may be from centrist Democrats to scale back the size of the fiscal package. Great insight there from Goldman Sachs. Everyone's telling us what's coming. Let's hope that we're listening and make the right decisions with our money now. Remember, if you're after the physical stuff, jump over to ainsleyboyan.com.au. We've got some new tigers in. Year of the Tiger, gold, silver, platinum coins. They're absolutely beautiful. We have already sold out of the platinum ones. They didn't last long at all, but we're still some gold and silver if you're interested in grabbing those. Remember, jump over to ainsleyboyan.com.au, or you can buy in store or over the phone if you're interested that way. Jump over to ainsleywealth.com.au for all things cryptocurrency. BTC looks like it's just pushed up a bit higher after its recent movement downwards. And jump over to goldsilverstandard.com for our own cryptocurrency built and backed by real gold and silver and stored at Reserve Vault. Enjoy your Wednesday, everybody. We'll catch you tomorrow for more Ainsley news.